everyone, back in November, Morgan Stanley had actually predicted that the S&P 500 would fall 6% in 2022, in what some called the most bearish forecast of the year. Well, turns out they weren't even close to how bad the slide would be. For more on this, let's welcome in Sam Rowe of TKer editor. Great to have you here with us today, Sam. Help us break this down even further.
Yeah, so I was actually on Yahoo Finance Live with you guys, and this is a good reason why people should be watching Yahoo Finance Live regularly. But we had a really great conversation last November when Morgan Stanley released their 2022 outlook for the stock market. And when they published it, it was the most bearish forecast on Wall Street, and they had this target of 4,400, and it implied a 6% decline from there. But when we spoke, we looked back at some of the history, and in an average year, the average max drawdown in the S&P 500 is about 14%. We're certainly far past that at this point, but the idea of seeing a 6% decline in the stock market at any point in a given year is relatively optimistic, considering history saying that markets tend to be pretty volatile.
Well, and considering, Sam, I think that investors, maybe they forgot about the financial crisis already and the volatility there. I think even with the pandemic drop, with the last couple of years and ample liquidity, that people just have become unaccustomed, perhaps, to this kind of action. And not just this kind of action, but sustained action like this.
Sure. Everyone's memory is always very short term, right? And don't forget, in 2021, there might have been 5% off, but I think it might have been close to zero. But 2021 was an incredibly stable, low volatile year. And earlier this week, actually, Deutsche Bank published a stat about how the S&P 500 has actually gone through 5 consecutive weeks, through last Friday, 5 consecutive weeks of declines, which is something that hasn't happened in years. But if you look back before the middle, like a few years after the financial crisis, all the way through history, long streaks of painful, slow bleeds in the stock market are not that unusual. So really, if there's anything that was unusual, it was last year with the low volatility, and the past 2 years with how much the stock market returned in such a short period of time.
Sam, how do the younger generation put it? Double click. I want to double click on the tech sector here. We just watched a bubble burst.
Yeah. Oh, absolutely. Some of these stocks are getting smoked. Like all of the work from home stocks that had such massive gains over this period, and everyone's talking about how bad Apple is suffering right now, and that's one of the biggest stock in the S&P 500. And everyone uses their products all the time, and the valuations are coming down. So yeah, in many ways you could say that the bubble has burst. Yeah, this is a whole lot of semantics that we're talking about, but yeah, no, stocks are down, stocks fall all the time. It's part of what investing is all about, right? Hopefully most people aren't in this to be making short-term trades to make a quick buck, because history also shows while you have these periods of volatility and while you have these periods of short-term losses, in the long run, if you're well diversified in the stock market, you can do very well.
Particularly, how does that change the valuation calculus if we see the cycle of purchases? We talk about the cyclicality of, new iPhones and consumers gravitating towards new devices that they're using on a day in, day out basis. How does a period like this impact those valuations if we were to see those cyclicality of those purchases change tremendously?
That's a great question. I think that's probably the most important question right now, especially on the tail of the consumer sentiment report that we just saw, right? So another thing to remember about the recent history is consumer sentiment has been getting pummeled since last June or middle of last summer, when the high inflation reports or the inflation report started to pick up. And so consumers started to notice this right away. And they responded to the consumer sentiment report, and they said it's a terrible time to be buying electronics, is a terrible time to be buying furniture, it's a terrible time to be buying houses. But what have we seen in the last 6 to 9 months? people are shopping relentlessly, and it's because more and more there's hundreds of thousands of jobs that continue to be created. Wages are going up, and in the wake of the early parts of the pandemic crisis, there was a whole lot of stimulus that was sent out, and that's still sitting on a lot of people's bank accounts. So the question is, how long will consumers continue to tolerate price increases in the cost of goods and the cost of living going up before they start to cut back on spending? Now, one last thing to note about this is there doesn't seem to be a whole lot of indication that people are pulling back on spending. Because don't forget, the inflation report that we just got, the category that was surging by the most was airline fares. And for a lot of airline fare spending, a lot of this is discretionary spending. So it's not so much that people are already cutting back because they're starving or whatever. And I'm sure there's definitely a lot of people who are struggling. But there's a lot of signs that say that there's discretionary spending that still continues. So maybe in next week's retail sales report, or maybe when we start getting retail earnings, we'll get a sense of the state of the consumer. But consumers are still spending. Well,
for what it's worth, Sam, I'm about to start trading down to buying rotten eggs at the supermarket because $7 for a dozen just ain't cutting it. Sam Rowe, TKer.com, TKer.co. Always good to see you. Thanks for bringing us those clickable headlines.